External sector. The external sector of a country refers to its economic interactions with the rest of the world. It includes various components such as trade in goods and services, foreign direct investment, FDI, foreign portfolio investment, FPI, external commercial borrowings, foreign exchange reserves, and exchange rate determination. India's balance of payments, BOP. The balance of payments is a record of all economic transactions between a country and the rest of the world over a specific period, typically a year. It consists of three main accounts. 1. Current account. This account records transactions related to the trade of goods and services, net income from abroad, such as remittances, dividends, and interest, and net transfers, like foreign aid and grants. 2. Capital account. The capital account records capital transactions, including FDI, FPI, external commercial borrowings, and changes in foreign exchange reserves. 3. Financial account. The financial account reflects the net change in foreign ownership of domestic assets and domestic ownership of foreign assets, including direct and portfolio investments. India's BOP performance. The balance of payment can be compared to two main sub-accounts. 1. Balance of trade. This is a component of the current account and reflects the difference between the value of a country's exports of goods and services and the value of its imports. 1. A trade surplus occurs when exports exceed imports, while a trade deficit occurs when imports exceed exports. 2. Current account versus capital account. The current account balance represents the net sum of trade in goods and services, net income from abroad, and net transfers. 2. A current account surplus means that the country is a net lender to the rest of the world, while a deficit indicates that it is a net borrower. 2. The capital account balance, on the other hand, represents the net change in foreign ownership of domestic assets and domestic ownership of foreign assets, including FDI, FPI, and external commercial borrowings. FDI and FPI in India. Foreign direct investment, FDI, refers to investments made by foreign entities directly into the productive assets of a country, such as factories, infrastructure, or businesses. FDI is generally for the long term and allows the investor to have significant control over the invested enterprise. Foreign portfolio investment, FPI, refers to investments made by foreign entities in financial assets such as stocks, bonds, and other securities. FPI is more liquid and can be easily bought or sold compared to FDI. External commercial borrowings, ECBs. ECBs are loans taken by Indian companies from foreign entities, including banks and financial institutions. These borrowings are in foreign currencies and are governed by specific guidelines set by the Reserve Bank of India, RBI. Foreign exchange reserves in India. Foreign exchange reserves are assets held by the central bank, RBI, in foreign currencies. They act as a cushion to stabilize the country's currency value and help in meeting international payment obligations. Foreign exchange reserves can be used to intervene in the foreign exchange market to control currency fluctuations. Foreign exchange rate determination in India. The exchange rate refers to the value of one country's currency relative to another. In India, the exchange rate is predominantly determined by market forces of demand and supply in the foreign exchange market. Factors such as trade balances, capital flows, inflation rates, interest rates, and geopolitical events influence the demand and supply of a currency, thus affecting its exchange rate. Types of exchange rate. There are various types of exchange rate systems that countries can adopt. 1. Fixed exchange rate. In this system, the value of the currency is fixed to another currency or a basket of currencies, and the central bank intervenes to maintain that fixed rate. 2. Floating exchange rate. In this system, the exchange rate is determined by market forces without any central bank intervention. 2. The rate fluctuates based on supply and demand for the currency. 3. Managed or dirty float. This system lies between fixed and floating exchange rates, where the central bank intervenes occasionally to influence the currency's value without fixing it outright. Capital and current account convertibility in India. Capital account convertibility refers to the ability to freely move capital in and out of a country for investment purposes without any restrictions. Current account convertibility, on the other hand, refers to the freedom to conduct trade in goods and services without any significant limitations. In India, the current account has been largely convertible since the early 1990s, allowing for easier trade and remittances. However, capital account convertibility has been managed with certain restrictions to prevent excessive volatility and protect the country's financial stability. Example of capital account convertibility: suppose a foreign investor wants to invest in a startup in India. If capital account convertibility is in place, the investor can freely bring in their investment funds and repatriate any profits or returns back to their home country without significant restrictions. Example of current account convertibility: if a business in India wants to import raw materials from another country, it can freely conduct the transaction without any major hurdles, and the payment can be made in foreign currency. Similarly, if an Indian service provider offers services to a foreign client, the payment received can be easily converted into Indian rupees without significant limitations. It is essential for countries to strike a balance between achieving openness in their external sector and safeguarding against potential economic vulnerabilities. Therefore, the degree of convertibility can be adjusted over time based on economic conditions and policy objectives.